Imagine it's 2008, the heart of a financial crisis. Banks are collapsing, stocks are plunging, and everywhere you look, investors are panicking. Yet amid this chaos, Aswath Damodaran pulls up his sleeves, asking the fundamental question: how do we actually value an asset when the market's screaming fire? That's the open loop, and cracking this code is exactly what his book, Investment Valuation, sets out to do. Valuation begins with cash, the real lifeblood investors want. But how do you turn uncertain future cash into today's dollar? Damodaran's DCF method makes that crystal clear. Damodaran famously dissected Amazon's wild growth phase, showing how projecting uncertain future cash flows and discounting them properly revealed Amazon's real worth in 2012, long before many skeptics jumped on board. His detailed walkthrough transformed what seemed like guesswork into a real, defensible valuation story. Think of the discount rate like gravity pulling future cash flows back to Earth. Just as you wouldn't want to jump off a skyscraper expecting to float, future money is worth less today because of risk and time. Setting the right rate is crucial. Too low, and you're dreaming; too high, you're paranoid. Damodaran flips valuation from a hazy art into an exact science. Instead of wild guesses, you base decisions on hard data: interest rates, market risk premiums, company specifics. That means investors can move from gut feelings to clear, repeatable insights that work even in chaotic markets. Not every asset is a blue-chip stock. How do you put a price tag on startups without history or companies on the brink of collapse? Damodaran's toolkit gets wild and practical here. Damodaran illustrates with a Silicon Valley startup clamoring for valuation during its seed round. Using real options, he explains how to value their future choices, like expanding product lines or pivoting. It's like pricing a game of chess, where every move has potential unfolding value. When companies teeter at bankruptcy's edge, traditional valuation fails. Damodaran walks through the GM crisis, showing how market value isn't just cash flows anymore, but also legal battles and restructuring costs. It's the financial equivalent of valuing a sinking ship with gold still on board. Private equity shuns public markets transparency. Damodaran explains how investors use discounted cash flow adjusted for control premiums and illiquidity discounts. Think of it as buying a classic car. You pay extra for the keys but factor in restoration risks. Markets are messy. Pure certainty is a myth. Damodaran's latest edition dives into probabilistic methods, where bets, risks, and simulations shine, rewriting how we see value. In a striking case, Damodaran models a pharmaceutical firm's drug trial outcomes with decision trees, mapping every regulatory hurdle and market launch scenario. Each branch carries a probability, slicing through fog to reveal where actual value lies amid uncertainty. Monte Carlo simulation is like shaking a box full of dice, thousands of times. In Damodaran's analysis of an emerging market investment, this method showed how wildly the valuations could swing, prepping investors for the full spectrum of outcomes, not just the average guess. The real breakthrough? You learn how to harness risk instead of fearing it. Damodaran shows that by embracing probabilistic tools, investors can turn uncertainty into a competitive edge, choosing strategies that pay off even when the future refuses to sit still. Back in 2008, when the financial world felt like a storm-tossed ship, Damodaran's approach was the lighthouse, guiding investors through the fog. Investment valuation teaches you to see beneath the market's panic and hype, arming you with tools to understand true worth. So try this: next time you check a stock, ask yourself not just what's the price, but what's the value here actually. You'll never see markets the same way again. Subscribe for more book summaries like this one.